Good evening. This is Duane Lowry for the DPP Grain Desk and Farms Technology. The Sunday night grain outlook is actually being recorded now on late Saturday night. It's currently about 10:50 on Saturday night. This week's schedule, I've got a lot of traveling this week. Tomorrow I'll be leaving early to go to Chicago. Going to take in a Cubs game on Monday night. Going to come back home on Tuesday, turn around Wednesday, go back to Chicago again. Um, so based on travel plans, I thought I would try to put this out tonight. I also don't think that tomorrow's weather forecast is going to make a whole lot of difference on the opening calls. The weather in general is right or wrong, is viewed as favorable, non-threatening. We've had a little bit of rain come through some of the drier areas of western Midwest late this last week. Amounts were in most areas half inch or less. A few areas did get greater than an inch. This week's forecast has limited precip in much of the western Midwest and the northern part of the central Midwest. Best rains over the next 2 weeks are going to probably favor southern areas. I'm not sure that the market really cares about the day-to-day nuances of weather here, basically being lumped in as being favorable or non-threatening, getting a bearish spin. The temperatures outlook is cool through the next 2 weeks, so we don't have any heat concerns. Marketplace views that as bearish. I don't necessarily fully agree with that assessment, but that is how the market wants to perceive it. Today in Iowa we were 60 degrees. So here you are on the 28th day of July, middle of the afternoon, and you're 60 degrees. I don't think that's what a late developing crop needs, whether it's corn or soybeans. Here in northeast Iowa, we've got some tassels out, but certainly not all of them. You can see the unevenness of the plants showing again in the field as the tassels pop out. Beans remain far, far behind normal. How that comes to impact final yields, I guess we'll wait and see. But I certainly don't think the conditions are favorable or ideal. You can argue about good conditions in the east, but there's an awful lot of acres out here in the west that I think are less than where they need to be to attain the national yields that the marketplace is currently pricing in. So the weather outlook I don't think is going to have a big impact on opening calls Sunday night. By default, the setting will be looking for some sort of weakness. We did see stabilization in markets last week in the case of wheat, in the last couple days in the case of corn. The soybean market took a nosedive in what appeared to be some sort of catch-up liquidation flush after the corn market led the way down. We'll get to the discussions of the beans later. First, I want to talk about wheat. There's not much here for news, and the reality is there hasn't been much for news in wheat for the last month. Wheat's basically been following corn or reacting to corn. It's, in my opinion, found a price level where global pricing activity is becoming pretty significant. The demand outlook has improved, I think, in most people's eyes. Carry out ideas for both U.S. and global wheat supplies, I think, are shrinking. Not that they're to some sort of too tight level. I'm not trying to imply that, but the carry out ideas are continuing to shrink. I think during the last month you've had price action largely stagnate. Wheat's gained about 40 cents on corn. Said another way, wheat's declined 40 cents less than what corn has declined. To put things in perspective, Friday's finish in settlement in Chicago wheat, those values were first traded in the early days of July. So from that perspective, we really haven't gone anywhere. And I think the technical conditions are not conducive to building downside momentum here. Technical conditions, in my opinion, are set up for a multi-week rally phase. Not just a temporary little bounce and then a resumption of a trend or anything like that. I think you're looking at fairly significant rally potential here. I think wheat can continue to gain on corn. I wouldn't be surprised Chicago wheat has $1 of upside potential here. If that is true, that has to imply that the corn market has limited downside risk and some sort of sizable recovery to unfold on its own. So we'll see. I don't think wheat has 20 cents of downside potential from current levels. I'm pretty bullish wheat here. I see the upside as being $1, and I think current levels offer ownership opportunities. As far as Sunday night's trade, I think it'll be based on trader sentiment being bearish, and so maybe the calls will come in here and be a little easier, but I don't think there'll be any downside momentum of any significance, and I think any weakness Sunday night can easily and quickly be rejected. So I view current values in wheat as an ownership opportunity. As far as corn is concerned, here again, I think the news is bearish. If you want to talk about weather, that's how the market is spinning it. There's not a lot of new news to talk about. I don't think there's a lot of new weather to discuss. I don't think the market's trading weather on a day-to-day basis. I think we're extremely saturated with bearish thinking. People talking about very large carryouts. They've been talking about this for some time, and I think you've got a market that's very oversold. The story is fully known. Long liquidation has been mature for probably a couple of weeks, and now you've been building short positions in what I think is going to prove to be a hole. I think you're going to see the latest shorts chased out of the market, and I think that's going to happen very quickly here. National production ideas had been at least 160 here a month ago. I don't see that as being likely, but in the same token, I understand how they come up with such a thinking. They see the weather as being, overall non-threatening. They've kind of discounted the lateness of the crop. They've discounted the early season wet conditions, and they're banking on eastern Midwest crops being exceptionally large to offset any problems in the West. Maybe that is how it comes to pass, but I think there's still a lot of question. I think when you've got the 28th day of July and you've got corn acres in Iowa that are not yet pollinating, and you got 60-degree temperatures and you've got a cool outlook for the next 2 weeks, I think there has to be some recognition, especially since the crop was planted so late, there has to be some recognition that there's a threat to being able to maximize full yield potential, because you're going to run out of growing season time. I think that the potential for an early season frost is a real threat this year. It's a greater threat than it would be in a normal year, and I don't think that the marketplace is giving much respect to those uncertainties. There's also not a lot of precip in the forecast over the next couple of weeks for a good portion of the northern parts of the Midwest, both eastern and western areas. So I just don't see weather here as being that ideal. I see crop conditions still having the same unevenness in the field that we had a month ago when we had excessive water. So I think there's still plenty of uncertainties. Technical conditions are extremely oversold, very much priced in an optimistic view, and I'm not sure that optimistic view of 160 national yield is still attainable. So I want no part of the bearish side of the corn market at this time. I think there's significant upside potential. Already talked about wheat. I think wheat has more upside potential than corn, but I think there is potential in corn. As far as soybeans are concerned, here too, I don't think weather particulars are going to have a lot of impact on the opening calls. Last week's soybean demise was led by the old crop August futures collapsing, and they were collapsing because the cash trade decided they're going to base everything off the November contract, which basically made the August contract largely obsolete, and significant liquidation pressures ensued. I think the spillover impact on November soybeans is difficult to justify, not necessarily surprising once the August began to tank, but yet something can be not surprising but still not be justified, and I think that's what you're dealing with here in beans. USDA has a 44.5 bushel national yield plugged into its working numbers. When you look at historical yields, I think that's a very optimistic yield. When you look at how late this year's crop was planted, the poor crop conditions in parts of the western Midwest where the crop is very, very late, the height of the beans is very poor compared to normal, and you had a lot of acres that never even got planted. I think there's plenty of uncertainty left The August period is always seen as an important part of the growing season. Why will this year be any different? It'll probably extend even into September. So I think there's a lot of uncertainties here regarding the beans, and it doesn't take much of an imagination to create a carryout situation in beans that just doesn't justify 12.25 November futures. If you try to put in perspective, since November of 2010, we've only experienced 17 Friday settlements for spot futures that were below current November soybean prices. That represents 12% of the time and involves 3 marketing seasons. So the current yield projections are quite optimistic, and that's what it takes to generate a supply-demand carryout figure that warrants current prices. And I think, historically speaking, it's going to be very difficult to attain, given the crop conditions and the lateness that we have this year. So I think that the bears have already factored in, I think, too much of an optimistic scenario towards yielding carryout. The amount of time that we spent at these prices for spot beans over the last 3 marketing years was about 12% of the time. And it doesn't take much of an imagination to reduce harvested acre by 500,000, lower yields by 1.5 bushels, and that would still be a relatively historically large national yield. Such a situation would create a carryout situation similar to 2011 and 12 marketing season, and from that harvest of 2011 through August of 2012, spot soybean futures spent 4 weeks below prices that are equivalent to today's November 2013 soybean prices. And I think most of that marketing year was spent in prices of $13 to $14. So it's not unreasonable to say that current prices are too cheap, but from a fundamental perspective, it's not unreasonable to look at the technical conditions and expect to have limited follow-through to last week's decline. And it's not unreasonable to view the bearish scenarios with great skepticism because of the lateness of the crop, and I think it's not unreasonable to view them in total disbelief. So bottom line, as far as I'm concerned, November soybean futures are completely underpriced given the uncertainties of a growing season still ahead of us and the potential for an early frost. So I want no part of any short position in beans. I think upside potential in all these markets is much greater than the current sentiment suggests, and I would view current values as offering ownership opportunities. For the DPP Grain Desk and Farms Technology, this is Duane Lowry. Thank you.